We're back, ladies and gentlemen, to talk about the repo market that just hit a brand new record of $2.4 trillion and why that's one of the clearest bad signs for the market. Who's this really bad for, though? Possibly the hedge funds that are at their highest net short levels of the stock market. Guys, lots to talk about. We have a big economic data point coming out tomorrow that will move the markets big heading into the weekend, and that could give us a little bit of this bullish or bearish momentum for the next couple of weeks until we get the next CPI report, which will be next week as well, or we get the Fed meeting, which is November 2nd. So we're going to go over AMC. We're going to talk about the markets. We're going to get into everything you need to know. Let's get straight into this video. Let's not waste any time. So it says the Fed's reverse repo just hit a fresh record of $2.4 trillion. Now, we're going to go over basically what this is. If you guys don't know what the reverse repo market is, essentially when the Fed raises rates, they're not raising rates for your auto loans, for these loans, right? It affects them, but what the Fed is actually doing when they raise rates is saying, hey, JP Morgan, if you need $1 billion from Citibank, it's going to cost you 3%. Next time the Fed raises rates, let's call it 3.5%. Next time Citibank needs money from JP Morgan, it's going to cost them 3.5%. It's affecting the borrowing rates between banks. In turn, that does affect the short end of the curve, the bond market, meaning the 3, 6, 12-month, 2-year bonds. It affects those. It doesn't affect the 30-year bond in the same way. It doesn't affect your mortgage rates. The banks really push and pull on that, and it's really up to the free market. But needless to say, when these banks park their extra money in the reverse repo market, because you can't just let trillions of dollars, billions of dollars sit on your balance sheet forever, right? If you don't have anywhere to put that money, you're not going out buying stocks with that money. You're not going out and giving out a whole bunch of loans because people aren't really going out to get a whole bunch of loans. What do you do with that extra money? You give it to the Fed and they give you the repurchase agreement rate, right? Usually overnight. That's why it's usually called the overnight reverse repurchase agreement market. And depending on what the Fed does with the actual federal funds rate, that's what you get paid out overnight. It's sitting at 3% as of currently. And what it really does, and why the Fed really is encouraging markets to put money into the reverse repurchase agreement, because like I just said, if banks are not out buying stocks, they're not out buying bonds, they're not out buying things or giving out loans with all this extra money, they got to put it somewhere. Why does the Fed like when banks put it with the reverse repurchase agreements? Because it's taking money out of the economy, out of the stock market, out of people's hands, and that should help inflation. So the Fed doesn't necessarily hate the fact that the reverse repurchase agreement market is so high, but it's telling you something. It's telling you that people don't want to invest their money, right? And let's go ahead and talk about exactly that. It says why this is a bad sign for the markets. The Fed is currently paying an overnight rate of 3.05% as of September 22nd, the highest yield since 2013. It increased from 2.30% after the central bank recently lifted interest rates by 0.75 percentage points. An increase in the reverse repo rate restricts cash supply and helps to correct inflation. However, whenever banks and other financial institutions have turned to the Fed's major lending facilities in the past, this has been a clear indicator of economic instability. It was strains on the repo market back in 2007 that brought about the financial panic of that year that led into the 2008 financial crisis. Uptake in the RRP facility could continue to increase depending on the supply of short-term investments and demand from money market funds, Fed officials noted in the July meeting. Bank of America strategists recently reported that investor sentiment is the worst it's been since 2008, and the bank anticipates that cash and commodities will continue to outperform bonds and stocks. Now, let's talk about this in the grand scope of us, right? The retail investors. Our money is not going into the reverse repurchase agreement market. What's it going into? It's going into stocks. So at a moment where hedge funds are at their lowest net long rates in the stock market, meaning they have the most short positions they've ever had in the history of the stock market right now, they're also parking trillions of dollars in the reverse repurchase agreement markets. Well, who's out buying stocks? It's retail investors. Retail investors, me, you, the next guy. We're out buying over $1 billion of stock every single day throughout 2022. Very rarely has there been a day where retail investors have bought less than $1 billion worth of stock. So in the end of this, what happens when the Fed does pivot, like we talked about in the last video? Go watch that if you guys have not already. Well, the retail investors, me and you, we're going to be the guys that really bank from this, because hedge funds aren't positioned for it. Money managers, other banks, they're not out buying the dip. Quite the opposite. They're taking their money out of the stock market at a record pace. So when the markets do finally flip, that's when retail will get paid out big. Now, this does mean that potentially more pain to come in the longer term, but here over the short term, if you guys really have not seen the video from earlier, definitely go ahead and watch that. I do think there will be a Fed pivot, a Fed slowdown, and that could mean for a massive market-wide short squeeze, but nonetheless, that's what is going on with the reverse repurchase agreement market as of right now, and that's what you guys need to know. It's not necessarily a great thing. It's not necessarily a bad thing, but what it is showing is that people are scared of the markets, not retail, banks and hedge funds. So when things do turn around, boy, is it going to be good for the retail investors, and are you going to see a short squeeze on epic proportions? Now, as far as more current things that are going to be happening, tomorrow, October 7th, that is Friday, you are going to get at 8:30 in the morning, the unemployment rate for September, which is expected to come in at 3.7%, and the non-farm payrolls for September also coming in at 8:30 in the morning, as well as participation rate, average hourly earnings, average hourly earnings year over year, month over month, average weekly hours, government payrolls, manufacturing payrolls, so on and so forth. A lot of employment data. Now, what this is really going to do for the markets is either be a very bullish or very negative thing. And this is a good way to look at it. The higher unemployment goes, the more bullish the market's going to be, right? Same thing for the non-farm payrolls. If that does continue to go lower, that's going to be a bullish thing. Basically, bad news will be seen as good news for the markets and potentially give us more room to see a Fed pivot coming possibly by November 2nd. That is the next time the Fed does raise rates. And let's take a look at the probabilities as of right now. The federal funds rate is sitting at 3.25%. It looks like the markets are firmly pricing in another 50 basis point rate hike as of right now, which would lead the federal funds rate in between 3.75% and 4%. The markets are expecting, as of right now and pricing in, the federal funds rate to be about 4.5% by the end of this year. So if we did get a Fed pivot, that is definitely going to, upset expectations in a good way, and that could give us a massive rally. And because hedge funds are not positioned for this, because there's very little long exposure in the markets as of right now, that's what would really give us a massive short squeeze. And tomorrow, if the unemployment rate does tick up, that's going to be something that, the markets are going to look at and say, hey, we might actually get this Fed pivot. We should probably be bullish on the equity markets. And that could actually start a little bit of a short squeeze. Now, nonetheless, that is basically it for tomorrow. You do have some Fed speakers as well. You do have Fed Williams at 10 o'clock in the morning. Wholesale inventories month over month for August at 10 o'clock in the morning as well. But that's basically it. and then you're going to head into the weekend, and then you're going to head into the next week, and you will get CPI next week as well. And if CPI comes down also, that's almost going to solidify a Fed slowdown, in my personal opinion. They're not going to stop raising rates, so don't bet on that, but they are going to slow down, in my personal opinion. The Bank of Australia, the UK, they have both done it. Japan, they haven't even really started raising rates or tightening financial conditions. They don't really need to, because inflation's not a problem over there. But nonetheless, you've seen a lot of the major central banks around the world already doing this, and considering the midterms are just around the corner, it only makes sense for the Fed to slow down at the November 2nd meeting. You also want to watch more Fed speakers, especially Fed Waller. Is it Fed Waller? Fed Williams, I believe, was it? Fed Williams tomorrow, because I think before we do get a full-on pivot from the Fed, we will get Fed speakers that start to talk about the Fed slowing down, raising rates. And we've already started to see that. So you want to watch and see if the language, if the conviction becomes stronger with these Fed speakers, and when they speak, if we're going to actually get a slowdown. And the markets, they're not really paying attention to a lot of the Fed speak right now, the Fed speeches, but it's something I've been paying very close attention to, and I think it's giving us a pretty clear sign of what is to come, something that makes me very, very bullish. Now, nonetheless, the S&P 500 down about 0.5% today. AMC stock up about 0.27%, still above this critical level at $6.88 per share by a decent margin, now sitting at $7.34 per share for AMC stock. The RSI is at 41.11, and the MACD is very neutral, not really bullish, not really bearish. We haven't been doing a lot with AMC. We haven't been dropping. We really haven't been rising all too much, a little bit over the past couple of days, but nothing quantifiably important or on a big level. It really hasn't been much of anything. Now, let's go ahead and refresh the Ortex data, take a fresh look at what we're getting reported, and we could see the estimated short interest of free float currently sitting at 19.14%, the free float out on loan at 35.87%, and the shares out on loan sitting at about 185 million shares. Days to cover at 4.42, cost to borrow at about 18.08, and 100% share utilization. If we take a look at the live cost to borrow rates, that is at cost to borrow max at 36.23% and cost to borrow average at 27%, cost to borrow minimum at 17.5%. And I do think a big reason why the cost to borrow rates have stayed over 30%, which is very high, is because we're probably going to see a big move here tomorrow and next week and over the next couple of weeks. The markets are going to move pretty big, in my personal opinion. So guys, that is basically it for this video. I hope this information made some sense to you guys. The Fed pivot, why it's only logical to see a Fed pivot from here. I hope it makes some sense, because this is really information that you should be able to profit off of, hopefully pretty nice. And obviously, I'm not a fortune teller, I'm not a financial advisor, I'm not any of those things, so don't fully listen to everything that's said. This does not mean go sell your whole portfolio and go YOLO into weekly calls. Not saying that at all. That's a recipe for disaster. But to get a little bit more bullish or have a better perspective on the markets as of right now, I think this is a good video for that. So thank you guys for watching. Hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Get your free stock with Webull, Moomoo, and Public as well down below in the description of this video. And if you guys want to trade with me live in real time, link down below in the description as well. You guys enjoy the rest of your day, and I will see you in the next one.